Chapter 2: Economic Opportunities and Financial Implications of Circular Business Models. In this chapter, we'll shortly discuss how circular strategies influence the costs and revenues of business models. We'll address the question of what economic opportunities circular business models offer and what financial implications they entail. Circular business models are all about using less resources while providing the same functionality. This not only makes them more sustainable, but also less dependent on volatile resource prices. By using less resources, these businesses are also more resilient in the case of supply disruptions. The strategies of the circular economy, such as designing products that are built to last or adding services that prolong product lifetimes, the circular economy also comes with the opportunity to strengthen customer relationships through product attachment and recurring customer relationships. Thirdly, the circular economy also unlocks many new options to either decrease costs or to unlock new revenue streams. Coming back to the different stages of the value hill as introduced in the previous chapter, the business strategies unlock many potential profit sources. Costs can be cut by recovering materials from disposed products and therefore needing less virgin materials. Costs can also be decreased through efficiency measures in the production process. Companies that sell long-life, high-quality products often have the possibility to charge higher prices for their premium product. In the use phase of their life cycle, companies have the chance to generate revenues from selling consumables or spare parts, or from providing services such as maintenance, upgrades, and repairs. And also from increasing the utilization rate, for example, from providing shared access through a pay-per-use service. After the use phase, additional revenues can be generated by selling used or remanufactured goods, or at least recovering valuable materials. After discussing the chances and opportunities that circular business models entail, we'll also go into the financial implications. Uphill business strategies mainly focus on the development phase. Products are designed to last, new material streams are developed, and processes are adapted accordingly. The main challenges therefore relate to the back-end side of the business model and the supply chain. For one, there are technological risks related to these strategies due to the novelty of these processes and materials. Another factor often are operational risks related to new uncertainties. Circular business models of these types therefore often require collaboration in the value chain and long-term partnerships to mitigate these risks. Top-hill strategies aim to maintain the value high during the use phase or optimize the access to the product by providing services. When products are rented, leased, or provided as a service to customers, the financial model of a company changes completely. If products are sold, they are immediately refinanced. On the other hand, products within service models need time to be profitable. The longer the lifetime of the product, the longer will usually also the payback period be. The company will therefore need an increased working capital to realize these strategies. Possible solutions are to shorten payback periods or to charge higher fees for new products to refinance higher quantities quickly. For companies changing from a sales to a service model, it might be also an option to introduce service models in stages. Downhill strategies aim to transform after-use products into new products or useful resources. One of the challenges is the question of how products come back to the manufacturer, or in other words, the reverse logistics. If products are provided as services, this isn't a problem, but if products are sold, an often applied solution are financial incentives. For example, by adding a deposit when the product is sold, which is refunded with the product return. Another challenge is often a functioning second-hand market which needs to be large enough and liquid. Furthermore, similar to new products, prices need to be stable. Secondary markets also often need distinct channels and transparent ways to match the supply and demand. Possibilities are warehouses or online platforms.